If you're a young adult, a low-income earner, or part of a vulnerable community, and a payday loan feels like your only option right now, perhaps to cover rent, groceries, or keep the lights on, please watch this video. We understand the immense pressure you might be facing. Because payday loans aren't designed to be a temporary bridge to help you out. They are strategically structured to become a continuous, inescapable loop. Once you're caught in this payday loan spiral, it can feel suffocating, making it almost impossible to breathe financially. Unless you equip yourself with knowledge, make a real plan and treat the situation as your number one financial emergency. We're here to help you understand and escape. Payday loans are typically small, often just a few $100s, and are marketed as 2-week cash to tide you over until your next paycheck. They seem like a simple solution when you're in a tight spot, offering immediate relief. However, the true cost and pricing structure are where the real trap lies. Research consistently shows that the typical fee is about $15 for every $100 borrowed for just 2 weeks. When annualized, this translates to an astonishing roughly 391% APR. This isn't a normal, fair loan product designed to help you build financial stability. It's a high-cost financial product specifically built for repeat use, preying on those with limited options. Here's how the debt spiral typically unfolds, often without you even realizing it. You borrow, say, $300 to cover an urgent expense. You're then expected to repay the full amount, plus the hefty fee in just 2 weeks. But the original reason you needed the money, rent, bills, food, is usually still there. This makes it incredibly difficult to pay the full balance when it's due. So, what happens next? You're often forced to roll it over, renew the loan, or even take out a new loan to cover the old one. The Consumer Financial Protection Bureau, CFPB, found that most payday loans are made to borrowers who keep rolling them over. The fees can quickly become greater than the original amount borrowed. In one CFPB example, a borrower could pay $360 in rollover fees after about 4 months and still owe the original $300. This clearly illustrates the payday loan business model. It thrives on fees, not on helping you achieve a payoff. This isn't an isolated incident, it's a widespread issue. Pew Charitable Trust research found that borrowers are often stuck in payday loan debt for about 5 months of the year on average, despite these loans being marketed as short-term solutions. A widely cited CFPB finding reported that a staggering 80% of payday loans are rolled over or renewed within 14 days. This is what we call the revolving door effect, keeping you trapped in a cycle of debt. So, if you find yourself stuck in this situation, please know you are not alone. You are experiencing exactly what this product is designed to produce, and it's not your fault for falling into a system designed to ensnare you. Payday loans don't just drain your money. They systematically erode your financial stability and peace of mind. They turn your next paycheck into a repayment event, forcing you to borrow again just to survive the rest of the month. This constant financial pressure can lead to a cascade of negative consequences. You might face late rent or utility payments, incur costly overdraft fees, or miss payments on other essential bills. Ultimately, it deepens your reliance on high-cost credit, making escape even harder. In the broader economy, this practice disproportionately concentrates financial harm in communities already under strain. These are often households that are underbanked or have limited access to traditional, affordable credit options. Now, let's talk about how you can break free from this cycle. To bust this spiral, you need a two-pronged approach: a stop the bleeding plan for immediate relief and a replacement plan for long-term stability. Stop the bleeding plan this week. Do not take a new payday loan to pay an old one. This is the core of the loop. Break this pattern immediately. Call the lender. Ask about any extended payment plan options your state requires or the company offers. Some plans can significantly reduce rollover fees compared to repeated renewals. Build immediate cash. Explore lawful, safe ways to generate funds. Sell items you can live without. Pick up extra shifts, or drastically reduce non-essential spending for 30 to 60 days. Treat this as a true financial emergency. Replacement plan, next 30 days. Seek alternatives. Look for options that won't trap you in rollover fees. Consider a credit union's small dollar loan, a payment plan with your utility provider or landlord, or community assistance resources. The goal is simple. Replace a 391% APR product with something survivable and sustainable. Create one rule. Commit to taking on no new debt until the payday loan cycle is completely broken. This discipline is crucial for regaining control. This journey will be challenging, but it is absolutely doable. Make breaking free from this debt your most important financial task. Payday loans often feel like a lifeline, offering quick cash when you're desperate. However, for most young adults, low-income earners, and vulnerable communities, they become a crushing weight that never lifts, unless you intentionally break the pattern. Thank you for watching this video. We hope it has provided you with valuable information and a clear path forward. If you found this video helpful, please click like to help others find this crucial information. And if you want more guidance on building financial literacy and managing debt, subscribe to our channel. We have many more videos in this series dedicated to empowering you to navigate these challenging financial times. Remember, you have the power to change your financial story. Take the first step today.